I wanted to dive in a little bit on this 10-year and 3-year, or the short rate and the long rate that Charles was talking about. Generally, we see these rates move pretty in lockstep. There are periods where they tend to diverge, and we saw a disinversion of the yield curve. So typically, long rates are higher than short rates, but when they invert, that can signal a bit of trouble. A lot of us might be familiar with the 10 minus 2-year spread. That's a recession indicator or an indicator of a troubled economy. When it disinverts, when the market is overheated, potentially could be signaling an economic disruption. However, that's not what we're seeing. It seems to be almost like we're hitting that sweet spot of a soft landing. And I think what we're seeing is, even though the short rate has come down and the long rate has started to rise, that's not necessarily crazy. It's not necessarily what we'd like as real estate investors. We would love low rates. We would love to be able to get good cap rates and good pricing on our loans. But it kind of makes sense when you think about long-term inflation expectations and a stabilizing economy, that yield curve changing back. And some of it could be, without getting too political, this is just economic fact. Some of the policies that the administration is proposing would, by general economic consensus, raise inflation. So a raised inflation in the long run leads to the 10-year Treasury increasing. So it could be expected that this situation starts to transpire. The other side is that it could just be an extra risk premium put on to long-term rates, or it could be a risk rotation that we've seen in other markets too, where investors come out of safe assets being put into risk-on assets, but remains to be seen what the long-term trend is going to be. But I think it's important to get good context on what is going on, and not just try to take the first order reality of these statements and look at the nth order, the longer term effects of what these things mean.